have one more guest joining us on the show right now, Mr. Ajay Kanwal, the MD and CEO at Jana Small Finance Bank, also with us. Mr. Kanwal, hi, wishing you a very happy new year. How are things at your end?
Very happy new year to all of you and all the viewers too. Yeah, things are good. Looking forward to 2025.
Looking forward to 2025, but you know, the latest headlines that are coming in for the banking universe haven't been that pretty, whether it's the MFI pain, whether it's the RBI stability report, or the words coming in from the brokerages, etc. We're talking about a bit of a moderation, if I must, in the credit growth. Are you worried about all of that? And is it the reality, moderation in credit growth is going to be the trend in 2025?
So from a relative basis, certainly yes. If you take the first half, the growth rate has been about 7% odd, one of the lowest growth rates in credit in the last 3 years. But I mean, all of you are well aware and it's well spoken of that, there is clear expectation that second half would be better. I think this will be led by a few things where inflation actually softens up. We could see better cost of funds coming in for both the banks as well as the customers. We clearly expect better government and private capex, which should certainly drive corporates and MSME. And third, I think there is the so-called geopolitical headwinds that people keep talking of. I think there is a bit of fatigue there too. So yes, first half has been challenging for banks in terms of growth. The bank balance sheets are very healthy, but I do think second half will be a lot better. When I did say I'm looking forward to 2025, I think it'll be a hardworking, challenging year. But I do feel looking at the numbers and talking to my colleagues, we probably will be more positively surprised the way banks perform.
Okay, more positively surprised than what the banks will perform, and you're expecting the H2 to be better than the first half. But since we're talking about a bit of a moderation in this year in terms of credit growth, what exactly should we pencil in? I think your advances growth has been around 30% in FY24, FY23, etc. What will it come down to in FY25 and FY26?
So we have guided the market to a 20% growth in assets and a 20% growth in deposits. And we are not changing that guidance for this year. For us, more important than just a 20% growth is the growth in secured assets, because that's the pivot we have been doing since we started the bank in 2018. So it's not just growth, it is good growth that matters to us. And we have seen a big shift. So let me give you the number. We began with about 60% secured assets in March 2024. As of September, we were at 65%. So it's not just 20% growth, but the bigger part of the growth, which is around 30% to 35%, will be in the secured asset piece. We pretty much feel that we will be able to meet that, and we haven't changed the guidance on asset or deposit growth.
Okay, so that's the outlook coming in. Also tell us that reports are suggesting some deteriorating credit culture due to farm loan waivers. Now, if you're not wrong, your agri exposure roughly is also overall 20% of the total unsecured lending. Are you anticipating any stress in this segment going ahead? What's the outlook when it comes to the entire agri portfolio of the business?
So our agri portfolio really is our microfinance lending, which are, the JLG model, the group guarantee model, which we do in the rural areas. Certainly our unbanked rural branches, which is 25% of our branch network, which is a regulation, as well as a BC network. We have seen the pain in the microfinance anyway in the first half. So incremental pain is not what we anticipate, either for us or for players who are playing in the microfinance space. The crop season doesn't point out to any negativity in terms of incomes. So I don't see an incremental challenge. I do see a bit of spillover depending on which bank it is and, what their growth rates have been. One thing I must tell you that I do feel that you will see divergences in bank performances. See, when you have challenging moments is when you see different balance sheets, secured versus unsecured, different paces of growth, different geographies. They will all play out in terms of performances. And I do think as we go into the next few quarters, you may not see a very similar performance across different banks.
Ajay, I want to specifically talk about one thing because I recall that during the last quarter conversation that, when we were chatting, you talked about as to how the degrowth in unsecured you think is not a long-term strategy. But as a cautious measure right now, you said that you're going to be slowing down the growth over there. Tell me, how is it that you're treating the unsecured segment now?
So, our growth rate in unsecured segment since 2018, when we began the bank till now, is about 1.5% CAGR. And our bias always has been that, listen, if you're running a large deposit-taking public institution, you really need to have a high level of secured assets. That's been our strategy all along. And we are at, like I mentioned earlier, 65% of September. And we publicly stated that we would like to get to 80%. So our thinking on unsecured asset has not shifted. It's a good class of asset to be in. But we do think from our bank strategy perspective, that should be 20% of our book at best. And that hasn't changed. And we will run that path as we go along. First half has been a bit more slower than what we would have planned or what we had planned. Our first half shrinkage of unsecured asset has been 6.5%. And that's been more tactical from a perspective that obviously the delinquency has risen. There is obviously a stress in the microfinance space. We would like to see how players, when they exit this space, how will they perform? By which I mean is, if you go back to the old ways of leveraging customers up, then I think we would like to retain our microfinance and unsecured book, even where we are at that pace of probably of just a marginal growth. But if there is more stability and more responsibility amongst the players, then we may want to increase it a bit more. But like I said, our mainstay is essentially secured assets. We have ridden that whole curve through the COVID piece, and it's done very well for us. We continue that path.
I also recall that you've been quite vocal about the ambitions of applying for a universal banking license as well. But, sort of the market remained cautious a little bit because of the NPAs, etc. Wanted to understand if you are still confident of keeping this ratio below 1%, your net NPAs, that is.
So, yeah, it's a tough one in a tough year. It's there in our numbers. We have provided extra 115 crores in the first half as accelerated provision to ensure the net NPAs remain below 1. We will continue to work on that as the next 2 quarters also pass. I must tell you the big challenge that we should have anticipated, and I must say we missed that in March. We couldn't see the unsecured stress coming in such a severe way when the year began. But we have already paid the big chunk of the cost in the first half. So I must say, sitting here, I'm very committed to making sure that we do our best to hit the less than 1% net NPA mark as we finish this year.
To the 1% mark, even though those universal banking expectations might just get kicked by a couple of quarters. But Mr. Kanwal, you said you're still maintaining that 20% growth target. Now, given the fact that the first half was weaker than what you anticipated, is it that Q3 has turned out much better? Are you expecting a sharp pickup in Q4? What makes you confident that you'll be able to hit that 20% mark?
So, if you look at first half, our growth rate was slow because unsecured was negative. But if you take a secured growth in the first half, that was roughly about 15 to 16%. So we didn't have slow growth in the first half in the secured asset, which is our primary focus and push. Also, as you always know, that the first quarter of all banks are a bit more slower. So third and fourth are much higher. So if you just take the secured asset growth and you assume that unsecured will not fall anymore, will remain probably there or marginally down or marginally up, I think 20% is pretty much something that we would still like to stick our head out for. And I'm primarily driving it by the secured asset growth, which first half is about 15 to 16%. So you analyze it, it should be higher than 30% for sure. And that will take the entire book around 20% for sure.
Mr. Kanwal, on that note, we'll let you go. Thanks so much for joining us today and wishing you the best in 2025.
Thank you so much. Bye-bye.
Okay.
If you like this video, then like, share and subscribe to ET Now.